In 2007, Warren Buffett made a $1 million bet. He said a simple S&P 500 index fund would outperform a basket of hand-picked hedge funds over 10 years. The hedge funds had some of the smartest investors on Wall Street, PhD economists, decades of experience, access to information most people could never get. 10 years later, the results came in. The index fund returned 125.8%. The average of the 5 hedge funds, 36.3%. It was not even close. This is week 3 of the Algorithm Investor. Today we are answering the question that sits at the heart of every investing decision. Index funds or picking stocks? Which actually wins? And the data is going to surprise you, because it surprised almost everyone who has looked at it honestly. Let us start with what each approach actually means, so we are all starting from the same place. Picking individual stocks means you research specific companies, decide which ones you think will grow, buy shares in those companies, and hope your research was right. An index fund means you buy a single investment that automatically holds every company in a given market. You are not betting on one company. You are betting on the market as a whole. On the surface, stock picking sounds more exciting, more intelligent, more like what a real investor does. But exciting and profitable are very different things. And the data on which approach actually builds more wealth over time is about as clear as data gets in finance. Here is the headline number. According to S&P's Espiva report, one of the most comprehensive studies of investment performance ever conducted, over a 20-year period, 90% of actively managed funds fail to beat a simple S&P 500 index fund. Read that again. 90% of professional fund managers, people who do this full-time, who have teams of analysts, who have access to every piece of financial data imaginable, fail to beat an index fund that does nothing except hold 500 companies. That is not an opinion. That is not a theory. That is the measured performance of thousands of funds over 2 decades. So why does stock picking feel like the smarter approach? Why do people still do it? 3 reasons. First, survivorship bias. You hear about the investors who picked the right stocks and made a fortune. You rarely hear about the far larger number who picked wrong and lost money. Second, recent winners. When a stock has gone up 300% in the last year, it feels obvious in hindsight. It feels like you would have seen it coming. You probably would not have. Third, overconfidence. Research consistently shows that humans overestimate their ability to predict future events, including stock prices, including professional investors who do this for a living. Now here is the nuanced truth that most finance channels skip. Index funds win on average. That does not mean nobody ever beats the market. Some investors do beat the market consistently over long periods. Warren Buffett himself is the most famous example. Peter Lynch, Joel Greenblatt, a handful of others. But here is what they all have in common. Extraordinary amounts of time devoted to research, access to management teams, decades of experience reading financial statements, and in many cases, genuine informational advantages that most retail investors simply do not have. For the vast majority of individual investors, meaning people with full-time jobs, families, and limited time to research companies, attempting to beat the market by picking stocks is statistically likely to result in worse performance than just buying an index fund. And here is the cost that almost nobody talks about. Every time you buy or sell a stock, you pay transaction costs. Even at zero commission brokerages, there is something called the bid-ask spread. Active traders also tend to sell winners too early and hold losers too long, a well-documented behavioral pattern called the disposition effect. And frequent trading triggers more taxable events, which further reduces your real after-tax return. When you add it all up, underperformance, transaction costs, tax drag, and the time cost of research, the average stock picker is not just failing to beat the market. They are often significantly behind it. So what is the index fund advantage in concrete numbers? Take 2 investors. Both start with $10,000 at age 30. Both invest for 35 years until age 65. Investor A picks stocks. They are reasonably skilled, not terrible, not exceptional. They average 7% per year after costs. By age 65, they have $106,765. Investor B buys a simple S&P 500 index fund, averaging 10% per year with minimal fees. By age 65, they have $281,024. That 3% annual difference, the gap between a decent stock picker and a simple index fund, compounds into $174,000 over 35 years. This is why fees matter so much. This is why the SPIVA data matters. 3% per year sounds small. Over a lifetime, it is life-changing. Now, does this mean you should never buy individual stocks? That is not quite what the data says. Many experienced investors use a core and satellite approach. The core, 80 to 90% of their portfolio, is in low-cost index funds. The satellite, 10 to 20%, is in carefully selected individual stocks they have high conviction in. This approach gives you the stability and long-term performance of index funds while allowing you to act on genuine research and conviction in specific companies you understand deeply. It is a sensible middle ground. But the key word is core. The index fund is the foundation. Individual stocks are the addition, not the strategy itself. Let us talk about which index funds to actually consider if you are just getting started. The S&P 500 Index Fund is the most widely recommended starting point. It holds the 500 largest U.S. companies and has returned approximately 10% per year on average over the past century. At Fidelity, FZROX or FXAX. At Vanguard, VOOO or VTI. At Schwab, SWTSX. All of these are essentially the same thing with slightly different construction. All have extremely low fees. If you want international exposure beyond U.S. companies, VT is a single fund that holds both U.S. and international stocks covering approximately 9,000 companies across the entire world. If you want the absolute simplest possible portfolio that requires almost no thought, VT and done. One fund. The entire global stock market. Hold it forever. Here is the bottom line from everything we have covered today. The data does not lie. Index funds outperform active stock picking for the overwhelming majority of investors over the long term. The reason is not that stock pickers are stupid. The reason is that markets are remarkably efficient. The price of a stock at any given moment already reflects an enormous amount of information from millions of participants. Consistently finding mispriced opportunities in that environment is genuinely hard. Hard enough that 90% of professionals fail at it over 20 years. You do not need to find the next Apple. You do not need to time the market. You do not need to be smarter than Wall Street. You just need to own the whole market, keep your costs low, and give compound growth the time it needs to do its work. That is the entire strategy. It is boring. It is proven. And it works. Next week on The Algorithm Investor, Week 4, we are going deep on ETFs. What they are, how they differ from index funds, and why they might be the most important financial innovation of the last 30 years. For the full breakdown on everything we cover each week and the tools to build real wealth, subscribe to The Algorithm Investor. New video every single week. Drop a comment below. Are you an index fund investor or a stock picker? Or somewhere in between? I read every single comment. See you next week.